Welcome back, everybody. I am Piancey, and I am here, as usual, with my partner in crime, Bennett Tomlin. How are you, buddy?
I'm doing great, Cass. How are you?
I'm doing good. We are recording, just to let everyone know, on August 6th, a Friday, and a lot has been going on today. Brian Brooks has resigned as the CEO of Binance US, which I guess comes as a surprise to some people out there, but not either of us. We're in high spirits right now. So hopefully I can stop that. I can turn that off right now by forcing us to discuss cryptocurrency lending. So there's a few platforms, and the main ones we're going to discuss today. There's probably a lot more. The main ones we're going to discuss today are BlockFi, Celsius Network, and Nexo. They're the big ones, and they're the ones we know of. So to start us off, can you explain just how crypto lending for these centralized platforms works? It's not the same as DeFi. So can you explain that, Bennett?
Sure. And in some respects, it is kind of similar to DeFi. A lot of the DeFi protocols are working on a similar concept, just without the central custodian. But for most of these platforms, you have a group of people who agree to lend out their assets in exchange for a certain amount of yield on them. So that would be you put your Bitcoins in a BlockFi BIA account, like the one all the security regulators are angry about, and over time you accumulate more Bitcoin because your Bitcoins have been lent out and the people receiving them pay interest on that. The other side of these is the people who are taking the loans, right? Who are getting your assets and using them generally to trade speculative cryptocurrencies. Most of these platforms require you to over-collateralize your loan. So say you want to get $10,000 in USDC from Nexo. In order to accomplish that, you're going to have to put up like half a Bitcoin as collateral, and they keep that half a Bitcoin. In exchange, you get your 10,000 USDC that someone else decided to lend out, and then you can use that to trade cryptocurrencies. At the end of your term, you pay back the loan, and the interest is dispersed to the people who lent you the USDC. And in a nutshell, that's how crypto lending works at these platforms.
Now, I want to point out something that just immediately jumps out to me. You say in your statement that someone is getting, let's say, USDC, USDT, some other stablecoin, and they are then utilizing that to purchase more cryptocurrency. But from what I was reading on Celsius Network's website, they aren't necessarily desiring you to do that, or at least in their legal terms, they're not. They're explicitly stating that you're not supposed to go out, take this USDC or USDT, and immediately purchase cryptocurrency. One, they say they're not advising that, but two, they say it's expressly against their terms of service to use the USDC, USDT, whatever, to then go out and purchase cryptocurrency on a platform that they're utilizing as well.
Yeah, you mentioned that to me before we started recording this, and I found it extraordinarily strange. Especially, my guess is their use of related platform might be more narrow than yours and my definition of related platform, because we know from previous reporting that Celsius will lend out these assets on Bitfinex. And I can't imagine that they believe the people taking the other side of those loans on Bitfinex aren't going to use it to trade cryptocurrencies. That's literally was like the differentiating feature for Bitfinex when it was getting started, is that you could get these margin loans to speculate on cryptocurrencies.
And second to that, we know that Tether holds equity in Celsius Network, but they're also loaning out tethers. So it's hard to imagine that while you're loaning out people tethers, that's essentially instantly a related entity. You're saying like, well, you can't use that to go purchase cryptocurrency. I mean, that's just obviously not going to be the case, right?
Well, luckily, in the case of Tether, it has so many other potential use cases besides speculating on cryptocurrencies. So obviously, you're getting your loan in tethers so that you can use tethers to pay your daily expenses, your trip to the grocery store, your insurance bill, things like that tethers are regularly used for. I think whatever legal jargon they're trying to put over it, it's very clear that the express purpose of these platforms is to allow people to lever up and further speculate on these cryptocurrencies, right? And it's the same reason that certain DeFi protocols like MakerDAO exist, because they understood the same concept. These over-collateralized cryptocurrency loans can be used as a way to just subtly increase the leverage in the system and allow people to maintain exposure to their collateral and continue to buy more cryptocurrencies, right?
Yeah, but I also think that we're almost skipping a step here, because while you're describing what is likely going on with all of these abilities to leverage, let's call them what they are, we're talking about this because of BlockFi. They are being taken on by 5 different states right now, and I'm just going to call that up: Texas, Mississippi, Kentucky, New Jersey, and Vermont have all taken them on in cease and desist orders and other financial restraining orders, I'll call them. But the most important of these is New Jersey, and you were the one who told me about that. Can you explain that a little bit more?
Yeah, so I think a lot of people took notice when New Jersey issued their notice, first because that's where BlockFi is located. BlockFi, did we figure that out yet? BlockFi is located in New Jersey, and the current head of the SEC's new director of enforcement was previously the New Jersey Attorney General. And like a lot of the current cast of like the enforcers at the SEC came out of this same group of New Jersey regulators. And so New Jersey, being the first one to move against BlockFi, followed quickly by all these other states, suggested to some that there was a possibility the SEC could eventually step in for some of these lending platforms as well.
Right. That's why that is important. But that's also important because it turns out Celsius Network is located in Hoboken, New Jersey also, which I found surprising. Like, we have 2 out of 3 of the lending platforms we're discussing located in the U.S. Is Nexo located in the U.S. as well?
On Nexo's website, they've got this question that is, where is Nexo registered and is it regulated? And there's a couple of sentences here that are pretty extraordinary. The first being that they don't really say where they're located, but they do say that they have legal entities in various locations throughout the world in order to service 200 plus jurisdictions in the most efficient manner and is in compliance with all applicable global and local regulations, which is a heck of a statement to make.
Right. And they're located, though, precisely in
Bulgaria, of course.
Bulgaria. Okay, Bulgaria. So we have 2 out of the U.S., 1 out of Bulgaria. I think Celsius also has headquarters or something in Lithuania, the U.K., and then 2 separate ones in New Jersey because they're operating one as a lender and one as a different business. To say one positive for Celsius Network while we're here, they are registered as a money services business. They have the number at the bottom of the page. And they are registered with the FinCEN. Now, Tether is also registered with FinCEN. That doesn't mean much, but at least 2 of those things are available. I think that cryptocurrency lending might be one of the few things that a lot of Bitcoiners would agree is a very risky thing with us, because this is not something new to the cryptocurrency space, right? I mean, we've seen this before. This is something that was common on Bitcoin Talk and on all these other early Bitcoin platforms where you had a bunch of people who were into high yield investment products asking to borrow your Bitcoin as collateral so they could earn 25% interest a month or something for you. It's such a cliche, but if it sounds too good to be true, it probably is.
And several of the points here do kind of seem like they're too good to be true. You were talking about this briefly before we started recording, about how the rates you pay when you borrow and the rates you get paid when you lend seem counterintuitive.
I just was trying to understand how they're earning so much money and how this is a profitable business when I looked, right, just the most basic math here that I could do. I go to earn, straight up, right away, it says earn up to 17% APY and get paid weekly. And then underneath that, it actually says 17.78% APY. So it's really closer to 18% APY. Free $50 in Bitcoin, right? All of this beautiful front-facing numbers that are just categorically unimaginable for someone who banks, right? Like, I don't know what your bank is currently giving out interest at, but I think mine is right next to zero.
Half of 1% maybe.
So these are amazing rates. And when I go to US rates, they're hovering around 9% for stablecoins. So this would genuinely be like me depositing my money at my bank and them offering me for a CD or something, 9% rates, which again, unfathomable. And then if I get paid internationally in the in-house token for Celsius network, those rates are hovering around 11%, 12%. So that's crazy. That's crazy in and of itself. But then I go to borrow, and the rates that I can borrow at, none of them are near that, first of all. But second of all, I can pay 1% interest rate. It's on an over-collateralized loan. But I can pay 1% interest rate and 7% and 9%. None of those reach those crazy amounts that I can earn from letting them borrow from me. And it's hard to work that math out, just basically.
Yeah, I certainly am struggling with it because it seems like if you were a large enough cryptocurrency investor who could put up the collateral, there's easy trades to be made here in taking a borrow out against those assets and then immediately relending out what you were lent and basically making the difference between those two rates, which suggests to me that the funds you're lending out when you're using one of these platforms, Celsius, Nexo, any of these, are not generally going to the borrowers who are borrowing from places like Celsius or Nexo, but these funds are being lent out on places where they can earn even higher yields.
Where would that be?
Well, I mean, we know for a fact that Celsius in the past has lent out to traders on Bitfinex, right? That they were using Bitfinex to lend out loans. I think both Celsius and Nexo are probably also lending out across some of the DeFi protocols where you can get higher yields than that. And so, yeah, I think that all of these companies are not just lending to their own customers, but are instead finding other places to lend these funds to in order to maintain these yields.
Now, I don't know, is there more you want to talk about in regard to the rates, or do you want to move on? Because there's a lot more to discuss here.
Yeah, I guess part of it is for me is that the rates they're promising on the earn and stuff are not actually unthinkable in crypto because there is like a certain amount of legitimate demand for people to get loaned these crypto assets, right? And so because of that, rates are going to run higher than the traditional banking system. My biggest frustration with all of these products is the way that they're marketed, with many of these companies claiming that to put your assets in their earn products, their interest-bearing products, is some kind of risk-free trade, when it just flat out is not that.
Well, it's fascinating to think that any of them would suggest that when you go down to the bottom of, I assume, any of their websites, really, a risk disclosure, and they're all going to have a terms of service and policy page. Now, when I looked at Celsius, those disclosures are pretty intense if you care about cryptocurrency and holding your own cryptocurrency, because they imply things like this. Celsius and our third-party partners may experience cyber attacks, extreme market conditions, or other operational or technical difficulties which could result in the immediate halt of transactions, either temporarily or permanently. Provided that Celsius has taken reasonable commercial and operational measures to prevent such events in technical systems controlled by Celsius, Celsius is not and will not be responsible or liable for any loss or damage. That's a huge, huge risk that you're taking if you're putting your collateral there. On top of that, they somehow try to position themselves so that they're not a custodian, they're not a bank deposit, they're not a certificate of deposit. They're not anything, but somehow they're able to get their hands on your crypto, take your crypto, loan out your crypto, and pay you interest on your crypto. Amazing. Amazing.
Yeah, no, it really is. And Nexo does not have quite that same risk disclosure that you described for Celsius. Theirs is much more mild. But, like, right on the main page for their earn product, beat volatility and earn without the risk in big, bold letters. None of these are risk-free platforms. They all have counterparty risks. Over-collateralization does not eliminate that risk, and they are all marketing these products as if they're a savings account at your bank with similar safety guarantees. And like you were listing for Celsius there, the actual guarantees are much less than the perception they're trying to create around them. I'm thinking back to like episode 19 we did with Frances Coppola, where she was talking about how the Bank of International Settlements treats these kind of assets as collateral. And these crypto assets are given 100% haircut.
Infinite collateral.
Yeah, you require infinite collateral to have like a loan collateralized in crypto. And none of these require infinite collateral to get a loan. And so there's again just this gap in understanding here. And even on a loan that's say 200% collateralized by Bitcoin, if Bitcoin drops 60% quickly, the loan is now under collateralized and you're back at risk of default. This over collateralization may reduce the risk of default and without a doubt does reduce the risk of default, but it does not eliminate the risk of default. And marketing as if it does is exploitive and is trying to take advantage of people in crypto who do not truly understand that type of counterparty risk or that type of volatility risk. And I think it's bad.
And to piggyback off that, not only is that bad and kind of ugly, but when you start to look into the terms of service and the risk disclosures for these companies that outright are saying stuff like get 10% risk-free. When you start to dig into the fine print, I find it personally horrifying. I'm sure that lawyers would tell me that there's plenty of companies that operate in the same way. I think that's also horrifying. But I want to share with people what these disclosures say, which is you cannot create a class action lawsuit against Celsius Network, at least. I don't know about Nexo or BlockFi. According to their terms of service, which who knows how much that'll stand ground in a legal sense, you cannot do a class action lawsuit. You have to go through arbitration before it ever would go to court. And that is through the American Arbitration Association. And for the most part, they indemnify themselves from all legal responsibility.
It's another one of those cases in crypto where these companies are trying very carefully to make themselves appear one way, when in actuality, they are not that. This seems very much like unregulated shadow banking that happens to use this specific type of asset rather than necessarily just US dollars. But all of these companies seem to be doing that exact same thing. And I personally, at least, have watched like BlockFi's reactions to these various cease and desist orders and restraining orders that have been filed against them. And it seems like their primary argument against these accounts not being considered a security or something like that is just that it's crypto, so it's different. And I'm skeptical of whether or not regulators will buy that argument.
I think the only point we're trying to drive home here is that there is a lot of risk. It may be unrealized right now, but there is a lot of risk involved in these lending platforms. And I genuinely think that a lot of coiners would agree with that. That's not insane to be like, guys, don't give BlockFi or Celsius Network a Bitcoin. I think a lot of coiners would agree with that because from 2014 on, they saw it a lot. It was a common theme. It's important to know those risks. It isn't risk-free. Mostly, it isn't insured. Mostly, they're trying to not be legally liable for the losses that they may cause to you. And it's important that people realize that. It's important that people realize that regulators really don't like them right now and that there's risks associated with that as well. Who knows when it comes to leverage, fraud, real use cases? I have no idea what's happening with this. I mean, we've heard people complain about not being able to use USDC for real use cases. I'm not going to name names, but I remember specifically someone saying, I just want to buy a used car or a car in Canada, and no one will accept USDC. What the hell? It's not shocking to me that normal businesses aren't accepting these things when crypto lenders And other people, including Binance and exchanges, are offering not only 18% APY, but occasional 100% and 60%. It's shady, risky, and if you can avoid it, avoid it.
Yeah, I think this is one case where I'm going to re-emphasize a Bitcoiner talking point, which is not your keys, not your coins. This applies certainly to custodial services, like if you have your coins on an exchange or with, any of the custodians, BitGo, Ledger, whatever. But it applies doubly so in cases where not only does the custodian not have the keys, but the coins have been actively lent out for use in speculative trading in an incredibly volatile and highly leveraged market. Those coins are certainly not yours, and all you can hope is that in the future you will again have access to them.
And I could be wrong, but I suspect we're going to get a really good idea of what it feels like and what happens when a large exchange can't sustain it anymore. Can't sustain the leverage, can't sustain the volume, whether it's because of a government shutdown or whether it's because of other factors, who knows. But I suspect we're going to see this play out in real time. And when we do, I really don't know if any of the crypto lenders are going to make it through unscathed. Maybe some of them will make it through, maybe, but unscathed, I don't think so.
It's certainly a risk I would have as part of my models if I was using any of these platforms right now. I'm not, though, because I wouldn't.
So I think that's going to do it. It drives our point home. Be careful out there. If you don't need to take these massive risks, which if you're poor, like us, you don't need to take those risks. And if you're not poor, you probably don't need to take those risks either. So generally, no one should be taking these risks unless they're the ultra wealthy. And they can go have whatever stupid amounts of fun they want. I don't care.
If you're rich and have a strong desire to become richer and you want to lend out a portion of your richness to help accomplish that, you know what? Go ahead.
All right, that's going to do it. Thanks for joining us and thank you for listening.